30 minutes. That is all it took. On February 10th, 2026, between 10 and 10:30 in the morning, $40 billion evaporated from the crypto market. Gone. It didn't happen because a CEO was arrested. It didn't happen because an exchange was hacked. There was no breaking news on the television. There was just silence and a straight red line going down. This wasn't a glitch. It wasn't a mistake. It was the mathematical inevitability of a broken system. If you are holding assets, right now you are confused. You are checking the news feeds, looking for the smoking gun. You won't find one because the gun wasn't fired by a person. It was fired by the market structure itself. This is what we call a silent crash. It is the most dangerous kind of wipeout because you don't see it coming. You can't prepare for it. You can't hedge against a ghost. And to understand why the floor just fell out from under the price, you have to look past the charts. You have to look at the plumbing of the financial system. It broke, and it broke fast. Imagine watching your screen. It is a normal Tuesday. Trading is flat. The market is boring. Then a single order hits the book, then another. Suddenly, prices aren't just dipping. They are free falling. Bitcoin drops 2% in moments. Ethereum follows. Solana, XRP, BNB, all bleeding out. In half an hour, the wealth of a small nation vanished into thin air. Investors scrambled. They refreshed their browsers. They panicked. Usually, when markets crash this hard, this fast, there is a reason, a specific catalyst. In 2022, FTX collapsed. In 2022, Terra Luna imploded to zero. Those were loud crashes. Everyone knew who to blame. But this time, the catalyst was the market itself. The scariest part isn't the $40 billion lost. It is that nobody stepped in to stop it. In a healthy market, when prices drop, buyers step in. They see a discount. They buy the dip. That creates a floor. On February 10th, there was no floor. The buyers were gone. The order books were empty. So when the selling started, the price didn't slide. It teleported. This wasn't a standard correction. It was a liquidity crisis. And it proves that the market is far more fragile than anyone realized. To understand the 30 minutes of violence, we have to look at the 4 months of pain that came before it. You cannot view this crash in isolation. It is the finale of a much longer, sadder story. Rewind to October 2025. The crypto market was sitting at the top of the world. The total market cap was over $4 trillion, $4.3 trillion to be exact. Greed was high. Everyone felt like a genius. The media was talking about a super cycle. They said prices would only go up. They said this time was different. Fast forward to February 2026. That number had crumbled to $2.3 trillion. That is a $2 trillion loss. Let that sink in. $2 trillion. For context, that is roughly the entire GDP of Canada simply ceasing to exist. We call this the slow bleed. The market didn't die overnight. It died by 1,000 cuts. Every day, prices ticked lower. Every week, a little more hope drained out of the system. Investors were tired. They were scared. And most importantly, they were broke. This set the stage for the disaster on February 10th. The system was exhausted. Think of the market like a dry forest in the middle of a drought. The trees are brittle. The ground is parched. It doesn't take a flamethrower to burn it down. It just takes one spark. The market was already terrified before the first sell order hit. We saw proof of this just 3 days prior. On February 7th, the exchange Bithumb made a mistake. A massive error. $40 billion worth of Bitcoin was accidentally moved. It was a fat finger error, a human mistake. Someone pressed the wrong button. For a few hours, chaos reigned, but then the truth came out. It was just a blunder. The funds were safe. The market laughed it off, but the reaction showed us the truth. Everyone was jumpy. Everyone was waiting for the other shoe to drop. It was like a gunshot going off in a crowded room. Even if it was an accident, everyone ducked. 3 days later, the real bullet hit. The difference between the Bithumb error and the February 10th crash is critical. One was human error. The other was systemic failure. The crash on the 10th exposed a liquidity trap. We need to define that. Liquidity is just a fancy word for cash available. When liquidity is high, there is plenty of cash on the sidelines. You can sell $1 billion of Bitcoin and the price barely moves because there are thousands of people waiting to buy it from you. When liquidity is low, the buyers have left the building. By February 2026, the institutions had pulled their bids. The retail investors were out of money from the slow bleed. The order books were thin. Imagine a door. Usually the door is wide enough for everyone to walk through, but on February 10th, the door shrank to the size of a keyhole. And everyone tried to run through it at the same time. When you have a massive number of sellers meeting a tiny number of buyers, price discovery breaks. The price has to drop drastically to find someone, anyone, willing to pay cash. This is why the drop was so vertical. It wasn't about the value of the technology. It wasn't about the future of finance. It was about desperate people trying to exit a burning theater that had no exits. And to make matters worse, the people selling weren't just selling because they wanted to. They were selling because they were forced to. This brings us to the leverage that blew up the system. You are betting on a coin flip. But you are not betting your own money. You are betting the bank's money. That is leverage. In the crypto market, traders love leverage. They put down $1 of their own cash to borrow $10 from an exchange. If the price goes up, they make 10 times the profit. It is euphoric. It feels like free money. But there is a catch, a deadly catch. If the price drops just a little bit, the exchange gets nervous. They don't want to lose their $10. So they don't ask you for permission. They don't send you an email. They forcibly sell your position to get their money back. This is called a liquidation. And on February 10th, this is exactly what fueled the fire. The market was over-leveraged. Too many people were betting with borrowed money. They were all betting long. They were betting the price would go up. When that first silent wave of selling hit, pushing Bitcoin down 2%, it triggered a tripwire. Thousands of these leveraged bets instantly went underwater. The exchange's computers woke up. They saw the risk, and they executed the kill switch. They sold the collateral. This created a domino effect. The forced selling drove the price down further. That drop triggered more liquidations, which drove the price down even further. It wasn't human panic selling anymore. It was algorithms. It was robots talking to robots, executing sell orders in milliseconds. This is why you saw a vertical red line. A human trader takes seconds to think, click, and confirm. A liquidation engine takes microseconds. The data confirms this violence. In the trading session surrounding this event, over $1 billion in positions were liquidated. Think about that number. $1 billion of bets were wiped off the board. These traders didn't just lose a percentage of their portfolio. They lost everything they put on the table. This mechanical cascade explains the speed, but it doesn't explain the depth. Why didn't it bounce back? Usually when a liquidation cascade happens, it's like a rubber band snapping. The price dips, smart money sees it's too low, and they buy it back up. We call that a V-shaped recovery. We didn't get a V-shape, we got an L-shape. The price dropped, and it stayed there. This brings us to the macro fear. This is the invisible hand pressing down on the market. To understand why nobody stepped in to buy the dip, you have to look outside of crypto. You have to look at the Federal Reserve. You have to look at the global economy. For years, money was cheap. Interest rates were low. When money is cheap, investors take risks. They buy Bitcoin, they buy tech stocks, they buy JPs of rocks. By February 2026, the party was over. Macro worries were strangling the economy. There were fears of interest rate changes. Institutions, the big banks, the hedge funds, the people with the deep pockets were in risk-off mode. Risk-off means they are scared. They are holding cash. They are buying gold. They are sitting on their hands. So when the crypto market crashed on that Tuesday morning, the institutional buy orders weren't there. The safety net that usually catches a crashing price had been removed. The market depth was thin. We call this thin liquidity. Imagine you are trying to sell a rare painting. If there are 100 collectors in the room screaming to buy it, you get a great price. But if the room is empty except for one guy offering you $5, guess what? The price of that painting is $5. On February 10th, the room was empty. The fragility of the system was exposed. Small sales caused big ripples. A standard sell-off turned into a tsunami because the water was too shallow. This shifts the psychological landscape entirely. For the last decade, the winning strategy in crypto was simple: buy the dip. Every time the price crashed, it roared back to new highs. It worked in 2017. It worked in 2020. It worked in 2024. But after the slow bleed of 2025 and the flash crash of 2026, that psychology is broken. Investors are traumatized. They bought the dip in November. They lost money. They bought the dip in January. They lost money. Now, when they see a red candle, they don't see an opportunity. They see a trap. The sentiment has shifted from greed to extreme fear, and fear is a powerful weapon. It drives prices lower than logic dictates. Analysts are looking at the charts, and the numbers are grim. The support lines, the imaginary floors we draw on graphs, are breaking. The next major downside target is sitting between $38,000 and $40,000 for Bitcoin. If we hit that, the pain we saw on February 10th will look like a warm-up. But the damage isn't just in the future, it is already on the balance sheets. Look at the corporate holders. Look at companies like MicroStrategy. They hold billions in Bitcoin. When the price sits at these lows, they are looking at massive unrealized losses. We are talking about billions of dollars in red ink. This creates a pressure cooker. If prices drop too low, these big whales might get squeezed. And if a whale gets squeezed, the splash drowns everyone. We are standing on the edge of a cliff. The $40 billion wipeout was the sound of the ground cracking beneath our feet. The question now is not, will it go back up? The question is, how far down does the canyon go? To answer that, we have to look at the lesson, the outlier lesson. Most people think price equals value. If Bitcoin is trading at a certain price, that must be what it is worth. That is false. In a low liquidity environment, like the one we are in right now, price does not reflect value. Price reflects panic. When you are forced to sell, you don't sell for what the asset is worth. You sell for what you can get. The February 10 crash taught us that the market can misunderstand the value of an asset by $40 billion in 30 minutes. That is not efficiency, that is chaos. And in chaos, there are two types of people, the victims and the architects. The victims get liquidated, the architects wait. So how do you survive this? How do you ensure you aren't the one providing exit liquidity for a panicked robot? You have to understand the difference between losing value and losing access. Because while the price chart is scary, there is something much worse than a red candle. And that is what we need to talk about next. The dust has settled. The algorithms have turned off. The red candles have stopped printing. Now we have to look at the wreckage. When $40 billion vanishes, it doesn't just disappear into the ether. It comes out of someone's pocket. And this time, it wasn't just the day traders living in their basements who felt the pain. It was the titans of the industry. We need to talk about the whales, specifically the corporate giants that turned their balance sheets into Bitcoin vaults. Look at MicroStrategy. For years, their strategy was simple. Buy Bitcoin, hold Bitcoin, repeat. It made them heroes during the bull run. But in a crash like this, that strategy becomes a heavy anchor. When the price plummeted on February 10th, the math turned ugly. We are looking at an estimated $4 billion in unrealized losses. Let me explain unrealized loss in fifth grade terms. It means on paper, you lost money. If you don't sell, you haven't actually lost the cash yet. But the psychological weight is crushing. Your net worth drops. Your investors get nervous. The board of directors starts asking hard questions. This changes the game. When a whale is underwater, it stops swimming. They stop buying. And remember, we are in a liquidity crisis. We need buyers. If the biggest buyers in the world are paralyzed by fear, who is left to save the market? Nobody. This leads to a massive shift in psychology. For the last 5 years, the internet shouted one phrase, buy the dip. It was a reflex. Price goes down, you buy more, you get rich. That reflex is dead. After the slow bleed of 2025 and the violence of February 2026, the retail investor is broken. Social media isn't buzzing with diamond hands anymore. It is buzzing with panic. When Bitcoin dropped, people didn't rush to buy the discount. They rushed to sell what they had left. They didn't see a bargain. They saw a falling knife. And the first rule of trading is never catch a falling knife. You will just get cut. This shift from greed to extreme fear is dangerous because it becomes a self-fulfilling prophecy. If everyone is scared, the price will drop, and they sell. Their selling makes the price drop, which makes them more scared. It is a death spiral. And now, all eyes are locked on one number, a number that terrifies the analysts, $38,000. Right now, we are hovering above it, but the charts are weak. If the trend continues, if the fear keeps driving the bus, analysts are predicting a slide down to the $38,000 to $40,000 range. Why does this number matter? Because below that, there is no safety net. There is no historical support. If we break 38,000, we enter uncharted territory. The free fall could accelerate. This is the reality of the post-February 10th world. We are walking on thin ice and the ice is cracking, but there is a lesson here. A lesson that separates the amateurs from the pros. This is the outlier lesson. In moments of extreme panic, in moments of low liquidity, price becomes a liar. Most people look at the screen and think, the price is down, so the asset must be bad. That is wrong. The price is down because the plumbing broke. The price is down because leverage got flushed. The price is down because people are scared. In a liquidity crisis, the price reflects the panic of the seller, not the value of the asset. Think about a house. If your neighbor's house is worth $1 million, but he has to sell it in 30 minutes to pay a loan shark, he might sell it for $10. Does that mean the house is worthless? No. It means the seller was desperate. The crypto market on February 10th was that desperate neighbor. The smart money knows this. They know that volatility cuts both ways. They know that a $40 billion wipeout in 30 minutes is not rational. It is emotional. But knowing this doesn't make it safe. You can be right and you can still go broke. Because even if the asset has value, if the market remains broken, the price can stay irrational longer than you can stay solvent. We have established the damage. We have established the fear. We have established that the price is lying to you. But there is a final danger. A danger that makes a price crash look like a minor inconvenience. Losing value is bad. Watching your portfolio drop by 50% hurts. But you still own the coins. You still have a chance to recover in 5 years. There is something worse than losing value. It is losing access. The crash of February 10th was a warning shot. It showed us the system is fragile. And when systems break, they don't just lower prices. Sometimes they lock the doors. We need to pivot. We need to stop looking at the red candles and start looking at the exits. Because the next crisis might not be about how much your Bitcoin is worth. It might be about whether you can get it out at all. You have to understand the difference between a fluctuating price and a broken machine. On February 10th, the machine broke. We have spent the last few minutes analyzing the red candles, the liquidation engines, and the panic selling. We looked at the numbers. We looked at the billions lost. But if you walk away from this thinking the problem is just volatility, you missed the point. The problem is systemic fragility. The crypto market of 2026 is not the same beast it was in 2021. Back then, there was infinite money entering the system. Today, the pipes are rusty. The liquidity, the oil that makes the engine run, has dried up. When you take $40 billion out of a market in 30 minutes, you are stress testing the infrastructure of the entire global financial system. And the results of that test were terrifying. The system buckled. This wipeout proved that the fair market price is a myth. In a healthy market, buyers and sellers meet in the middle. They agree on a value. But on that Tuesday morning, there was no agreement. There was only a stampede. The price of Bitcoin didn't drop because the technology failed. It didn't drop because the blockchain stopped producing blocks. It dropped because the exit door was too small for the crowd. This is the outlier lesson you need to tattoo on your brain. In a crisis, liquidity is the only thing that matters. You can hold the most valuable asset on earth. You can hold gold. You can hold diamonds. You can hold Bitcoin. But if nobody has the cash to buy it from you when you need to sell, it is worth exactly zero. The $38,000 downside target that analysts are screaming about, that isn't just a number on a chart. That is the breaking point for the plumbing. If we crash through that floor, we aren't just looking at lower prices. We are looking at a potential freeze. We are looking at exchanges pausing withdrawals because they can't handle the rush. We are looking at the difference between a paper loss and a total loss. This brings us to the most dangerous realization of all. For the last 4 months, during the slow bleed of late 2025, investors were worried about their portfolio value. They checked their apps every day, watching the number go down. They felt poor, they felt regret, but they were focused on the wrong risk. They were focused on price risk. Price risk is normal. Markets go up, markets go down. You can recover from price risk, you can wait it out, you can buy more. The crash of February 10th exposed structure risk. Structure risk is when the casino itself catches fire. It doesn't matter what cards you are holding if the building burns down. When liquidity vanishes this fast, it puts massive pressure on the custodians, the exchanges, the lenders, the platforms where your money lives. If MicroStrategy is underwater by $4 billion, that is a problem for its shareholders. But if your exchange is underwater because they were lending out customer assets to chase yield in a dying market, that is a problem for you. A $40 billion wipeout doesn't happen in a vacuum. Someone was on the wrong side of that trade. And history tells us that when big players lose big money, they start looking for pockets to pick. Usually those pockets belong to the retail investor. You need to stop asking, will Bitcoin go back up? And start asking, is my Bitcoin safe where it is sitting? Because a price crash is painful, but it is temporary. Insolvency is permanent. We saw this movie before. We saw it when the second largest exchange in the world collapsed overnight, taking $8 billion of customer money with it. It looked like a liquidity crisis at first. It looked like a bank run. But when they opened the vault, it was empty. That event changed the world. It wasn't a market crash. It was a crime scene. And if you don't know the specific signals that flashed right before the doors locked, you are flying blind in a storm. You need to know how to spot the difference between a bad day in the market and a total systemic collapse. The signs are there if you know where to look. Click this video right here. I'm going to break down the mechanics of the 2022 FTX collapse step by step so you can see exactly what happens when the liquidity dries up and the insolvency begins. Stop watching the charts. Start watching the exits. Click here.